So OPEC Plus plans yet another increase in oil production. Our guest says, yep, markets are headed for oversupply. We're joined by Reid I'Anson, economist at Kpler. Reid, great to see you. Thanks very much for joining us. We've heard talk that some of these barrels are already in the market, and there hasn't really been such a buildup of OECD inventories, but you do see a real risk of a surplus in the crude market.
Yeah, through the summer period, we've really seen pretty heavy crude burn in the Middle East, and that has allowed the supply-demand balance to remain relatively in balance. But we do think that heading into Q4, we're going to see an oil supply outpacing demand by 2.5 to 3 million barrels per day at current trajectories. And also just talking on OECD inventories, I think something that's really important to focus on right now is watching Chinese inventories. They really heavily restocked earlier this year. And so you also, when we're talking about this global oil picture and global oil inventories more broadly, China is a critical piece of that story as well.
So the Chinese have already bought a lot of oil, so that implies they won't be needing so much in months to come?
It's a bit of an open question whether they want to do more restocking. Of course, there is a geopolitical question here when it comes to their SPR. They may be willing to do more restocking. It's a bit of an open question, so we're going to have to watch things. But again, a lot of that is just a transfer of oil from under the ground to above ground storage tanks. It's not real demand being consumed by Chinese refineries. But it is important to keep in mind that could provide some modicum of buying support here in the short run if, again, the Chinese government deems a desire to continue filling that SPR.
China, of course, crucial to, or has been over the past decades, to commodity consumption. You reckon their economy still very unbalanced, still with an excessive focus on manufacturing and exports as opposed to domestic consumption?
We've spoken a number of times about this already this year, right here on BNN, about the issues with the Chinese economy. They are facing critical problems of economic imbalance, right? A high reliance on manufacturing investment and net exports. Just through the first half of this year, that 5.3% growth level that they reported, we think that a full percentage point of that was just net exports alone, right? And if you look at the trade surplus this year, it's up by more than 150 billion from the same period last year. So again, a lot of evidence right now that China continues to rely heavily on this manufacturing investment and net export story. And at the same time, we've actually seen weakening in consumption growth over the past couple of months. So not a good sign that we're seeing a lot of rebalancing towards the consumption side of the economy in China right now.
Why does it matter if the Chinese economy is unbalanced, though? Part of their obsession with manufacturing, for example, stimulating protectionism around the world?
I think that when you're thinking about this investment-led growth model in China, a lot of this is being driven by the fact that firms are paying suppressed wages relative to productivity levels in China. This not only benefits Chinese firms, but also U.S. firms that have moved their supply chains into China. Of course, this allows for a high degree of profitability for these firms, but it comes at the expense of consumption, not only in places like China, but also weighs on wage growth in places like the United States. And so it's our view that, Donald Trump kind of tiptoed into this issue earlier this year, when it comes to this Chinese oversupply issue, because again, it also impacts the ability of U.S. workers to negotiate wages here in the United States. And actually, over the last 15 years, we've seen the labor share of the U.S. economy precipitously decline. And we think it's, a key part of this is because of pretty wide trade imbalances globally, driven by China.
So ultimately, if they cut back on infrastructure investment, they'll be using up less copper. I mean, obviously, a shift to domestic consumption will mean they'll need commodities, but you think less infrastructure investment means lower commodity consumption in the near term?
I think it really depends on what the United States wants to do, right? If the US continues to run very wide trade deficits, it's likely that China's growth model, as we see it now, will continue, right? The United States accounts for more than 50% of the global trade deficit. But I think if the United States shows a willingness to really begin narrowing its trade deficit, this will push China to change its ways. But right now, it looks like Trump is stepping back from its desire to really take on these trade imbalances. And so, over the next 2 or 3 years, I think China continues to grow via this manufacturing-led method and net export-led method. So I think if we're talking about this move towards consumption, probably comes later this decade with more political pressure out of the United States, and that could begin to affect Chinese metals demand. But for now, I think that this dynamic could remain in place for another 2 or 3 years.
What about the US dollar? And actually, touch on stagflation. Is it a real risk for America? Because obviously that would not tend to be good for commodity consumption, even though the prices might go up nominally.
Yeah, I mean, I think stagflation's a real risk. We see growth in the US at 1.3% this year, and inflation holding at or above 3%, right? That's a pretty stagflationary environment. And this is why you see the Fed kind of in a difficult position. Do you focus on the inflation mandate, or do you focus on the growth and full employment mandate? It looks like the Fed is starting to shift towards focusing on its employment mandate. We're probably going to get a pretty aggressive set of rate cuts here. At least that's what the market's implying. But that does create concerns around inflation. I think when you're thinking about the direction of the dollar, keep in mind we have seen a lot of dollar weakness. Most of this aggressive rate cut cycle that's being priced by the market is already been factored into the dollar. So again, I think right now we could probably see the dollar kind of chop sideways unless we get a real growth scare. And the US shows a lot weaker growth relative to places like Japan or Europe. You could see further weakness. Now, however, I think longer term, you are going to see more of a desire to diversify away from the dollar. And so we do see more structural weakness. But at least in the short to medium term, I think we're probably going to see the dollar kind of chop sideways from here.
Reid, thanks very much indeed for joining us.
Thanks.
Reid I'Anson, economist at Kpler.